Joe Henry again, aka the semi-retired guy, bringing you another video on stock investing. But before we get started, what do you think of the new do? They called it the Pandemic Special. Got it at a black market barbershop, late at night. So how are you feeling right now about the stock market? Are you worried that the coronavirus is going to cause another Great Depression? Are you afraid to buy stocks right now because of that? Well, if so, take a look at this chart of the S&P 500 over the past 150 years. As you can see, the S&P 500 has always recovered fairly quickly after a pandemic. You know, this is the fourth one we've had since 1918. Will it be different this time? Who knows? Now that I put you at ease, let's take a look at the three stocks that should do well right now. First up, T. Rowe Price. Who hasn't heard of T. Rowe Price? They're one of the largest publicly held mutual fund companies in the world. They have $1.2 trillion under management. That's trillion with a T. That's a lot of piggy banks, folks. They sell actively managed mutual funds, and they also advise individuals and institutions. 2/3 of their assets under management are retirement related, meaning that they are sticky. People don't like to move their retirement account around too much, if you know what I mean. They have a lot of room to expand globally. Their international clients account for less than 10% of their assets under management. In terms of financial trends, in the last 5 years, their assets under management have grown at a compounded annual growth rate of over 10%. Their revenues at 7.1% and their profits at 4.8%. Not too shabby. Why do I like them? Well, T. Rowe Price is part of an elite group of companies called Dividend Champions. These are companies that have increased their dividends consecutively for over 25 years. In T. Rowe's case, that's 34 years. A little secret, most of the stocks I own are Dividend Champions. As a group, these stocks have been found to have a higher return than the S&P 500 with lower volatility in the long term. Well, let's talk about valuation now. Is T. Rowe Price stock undervalued, overvalued, or what? Well, by the metrics I look at, PEG ratio to the sector average, price to book ratio to sector average, T. Rowe is undervalued. However, when you look at the price versus fair value, the stock is not undervalued. In fact, it's overvalued by a little over 14%. Oh well, you can't have everything. If you waited to have all your stars aligned, all your I's dotted, you'd probably never buy anything. Well, how did you get the fair value calculation, you might ask? I could tell you, but then I'd have to kill you. Actually, there are several analysts like CFRA, The Street, and others which provide this information to you on your brokerage's website. So take a look sometime. Now, ideally, you want to make sure that the current price of the stock is less than its fair value. That way you know you're getting an undervalued stock. Here's a few hints about the next stock I'm going to talk about. If you guessed General Dynamics, you'd be right. General Dynamics is a top 5 defense contractor, and it's also the leading manufacturer of business jets. Now let's take a look at their sources of revenue. First off, the business jets, that's 25%. Marine systems, that's 23%. Mostly are nuclear subs, but also some destroyers. Combat systems, that's 18% of revenues. Military vehicles, weapon systems like heavy machine gun, grenade launchers, Gatling guns, all kinds of good toys. Finally, information technology, 22%. They are helping the Department of Defense move all of their computer work to the cloud. So as you can see, most of General Dynamics' revenues seems to be coming from their defense contracting business. Is that a good industry to be in right now? Hell yes! Global defense spending hit $1.917 trillion in 2019, a 3.6% increase over previous year figures and the largest increase in 1 year since 2010. And unless you've been vacationing on Mars or Saturn this spring, you already know that there seems to be a new Cold War brewing between the US and China. This should bode well for the defense industry. Now, aside from the fact that they make jets and tanks and guns, I also like their financial picture. It's an undervalued stock based on all three financial metrics we use to determine value. The PEG ratio and the price to book ratio are both lower than its sector average. In addition, its price is less than its fair value. Finally, this boy is another one of my dividend champions. It's been growing its dividend consecutively for the past 29 years. Currently, it's got a yield of 3.3%. Its payout ratio is well under 50% at 36.7%, so we know it can keep pumping out those dividends without any problem. Now, last but not least, let's talk about Facebook. What? This is not a dividend champion. This stock doesn't even have a dividend. Why do I like it? Because it's the mother of all marketing advertising platforms. 2.7 billion people, a third of the world's population, uses a Facebook-owned service like Facebook, Instagram, WhatsApp, or Messenger every month. If you currently don't use one of these services yourself, well, let's just say you're beyond square. You're a trapezoid or some other type of dorky beast. And because of the information that Facebook-owned entities collects on each of you, its ability to target advertisements to a particular market segment is unsurpassed. For example, Facebook can target customers based on geography, age, gender, political views, job titles, ethnicity, just to name a few characteristics. Facebook knows more about you than your mother knows about you. Historically, more than 3/4 of Facebook's revenues have come from advertising. The balance comes from payments, largely from purchases of virtual goods within social games. Yeah, I've never bought any of that stuff either. Facebook's growing at an unbelievable rate for such a large company. In the past 5 years, its annual revenue and earnings have grown at a rate of 42%. In its most recent quarter, Q1 of 2020, it doubled its profits from a year ago while growing its revenues 17% to $17.74 billion. And that was a beat by over $500 million. And while the rest of the country had a horrible April, Facebook ad revenue was merely flat from a year earlier, showing that e-commerce ad revenue was resilient in the face of the biggest economic slowdown since the Great Depression. And this is important because who really knows how long this downturn will last and whether there'll be a second wave next winter. With a great balance sheet of $52 billion in cash and virtually no debt, Facebook has the money it needs to defend its competitive position, invest in new developments, and also survive any economic downturn, including a coronavirus resurgence. The pandemic has also resulted in a recent surge of online communication among Facebook members and live streaming gaming. FaceTime and video group calling, for example, have skyrocketed 1,000% in April. Daily active users, meanwhile, increased 11% to 1.73 billion. Regarding future growth and risks, the top line and bottom lines in 2021 are expected to increase 22% and 43% respectively. Privacy concerns could come up again, but based on the past performance of this stock, I think I would buy on any dip. So how do you value a growth stock like Facebook? Well, you can start off by looking at the same metrics we looked at with dividend stocks: PEG ratio, price to book ratio, and discounted cash flow. For Facebook, their PEG ratio is 1.86 versus 2.95 in their peers, so it's underrated by that metric. Price to book is 5.75 versus 6.13. Again, undervalued. We can look at fair value by discounted cash flow. At its current price of $202 a share, fair value by discounted cash flow is 204.63 by CFRA and 258 by Credit Suisse. So in that measure, it is slightly undervalued to very undervalued, depending on which analyst you believe. So there you have it, 3 stocks to buy right now. The first 2 are dividend champions, and anytime you can buy them at a discount, you should buy them. The last one, Facebook, is a stock to buy for the new normal. the post-pandemic world in which we interact online more than in person, where we play Words with Friends instead of Scrabble, and where we hear about new products and services online in our news feed on Facebook instead of on TV, a newspaper, or in a magazine. If you like this video, please click on the thumbs up. If you'd like to subscribe to my channel, please hit the subscribe button. Finally, the Semi-Retired Guy's videos and writings do not constitute financial advice in any way whatsoever. Nothing published by the Semi-Retired Guy constitutes an investment recommendation, nor should any data or content published by the Semi-Retired Guy be relied upon for any investment activity. Semi-Retired Guy strongly recommends that you perform your own independent research and or speak with a qualified investment professional before making any financial decisions.